This week, the markets are focusing on one of the biggest Fed announcements in recent times. When will the $85 billion bond buying program come to an end? So today, I'm focusing on the US dollar, examining the price levels and sentiment, along with other current issues and theories associated with the index. On the line, I'm joined by Ashraf Laidi, Chief Global Strategist at City Index in London. Thanks for joining me today, Mr. Laidi. Now, a couple of weeks ago, you said it's a worrying time for the US dollar. Do you still feel that same way now?
Yes, after a brief interruption of that worrying slide, there was a brief interruption, there was a slight rally. We saw the euro coming back down towards 131. We saw the dollar yen retesting 100.5. And but the recent pullback lower in the US dollar does look like it's probably a return to what may be a more protracted trend into the next few weeks. That is seen, technically by the continued support in euro dollar at 131. And also, even though cable sterling versus the dollar is testing 1.6, which is supposedly a technical level, it seems that we could even see 161, 162. And dollar yen, which seemed to have broken above a downward channel, seems to have broken out of that, but that was only temporary, and now it seems to be giving us signs of a fake breakout. And to delve a little bit more on the technicals before we go on the fundamentals, is that if you look at the weekly chart of dollar yen, you will see that on the monthly chart we are supported above the 100-month moving average. But even though we've broken above on the weekly chart, even though we've broken above the July trend line or the top of the July channel, we are coming back down. And we may be testing 98, but dollar yen is not the most worrying symbol of it. It's really dollar Swiss, dollar CAD, sterling dollar, which many people are saying it is overbought. It may be overbought, and the surprise data may be running out of steam. But neither the Bank of England is showing signs of turning more dovish, nor the data is really showing any signs of decline. So as for the euro dollar, it really seems that we may see probably the obligatory pullback after the volatility, after the FOMC, towards probably 130, even 132.50, 132.30. But I think we're going to have a nice retest of 134.50, and even probably we could see 130, 135. It seems impossible that the Fed is going to taper more than 10 billion. 10 billion or less, it's priced in, and therefore, because it's priced in, I think it's probably going to be dollar neutral to negative.
Now, you say traders of the dollar, aside from the FOMC meeting today and tomorrow, will be looking to President Obama's corporate tax reforms and the small chance taxes could be cut on foreign earnings from US multinationals as being some of the next key market-moving events. Will we see the same strength from the dollar we saw back in 2004 when former President George Bush introduced similar reforms?
Right. Well, I wrote that a while ago, and a lot of things happened after that. Such as the debt ceiling, which is going to come back and haunt us in October, and other things was the Syria story. But going back to that reform, it was discussed. It has been discussed for the past 2 years whether Obama is going to do it or not. Basically, he's going to encourage U.S. multinationals to bring money, to repatriate money at a lower tax rate, which would eventually be dollar positive. But it seems that this is making noise again. It was making noise again around 2 months ago. It is not right now. So as long as it does not, it doesn't seem to be any positivity for the dollar. People are saying that eventually the Federal Reserve, the positive argument for the dollar is that the Federal Reserve is the central bank closest to tapering or to withdrawing liquidity than any other ones. Therefore, it should really help the U.S. dollar. But with that is coming the insistence by the Federal Reserve to say that we are continuing to add liquidity and to keep markets accommodated and to still buy asset purchases, to do still asset purchases, and reducing a car from 85 miles an hour to 70 miles an hour doesn't mean that the car is really slowing down. It's just like that's exactly what it is. It's a tapering of the liquidity. It's a tapering of the speed, but the car still continues to go quite fast. But the argument here that is supposed to be guiding towards dollar weakness is really that of more of a technicals. I think the Fed is. I think the bond market is going to pay attention more towards the fact that it's less on tapering and more on the fact that it is not going to be raising rates anytime soon, and we know it's not going to do that before a year and a half or 2 years' time. But the dollar bulls could be saying that, but they are tapering, and that's a good thing. But the Fed is really making sure that it's going to continue to provide liquidity and so on and so forth. And but technically, I think the pullbacks in the euro are more of a buy right now.
How long do you think it will be until announcements coming from the Federal Reserve become more scrutinized by the markets?
If the data continues to be well, if let's say if the unemployment rate reaches 7%, and that is the level at which Ben Bernanke suggested that 7% unemployment is the level at which they should stop. They should have tapered all of the 85 billion. Then if now unemployment is at 7.3, then they should definitely start to taper. So I think the criticality or the criticism will become really if we see a continued improvement in the job market. Some people may argue, they say it's not really a real improvement because of the participation rate and so on and so forth. But if the jobless claims continue to hover around 300,000 and the unemployment rate remains below 7.5 and it continues to weaken, and the Federal Reserve, let's assume it does 10 billion this year, and this month, and it doesn't do anything from here in December, it will be criticized. If we see a pickup in inflation data, which we were not really seeing, then it will be criticized in case it doesn't do anything. But I think people need to see who is going to be appointed as the Fed chairman before they're going to start to criticize. But having said that, the people who are looking at the negatives of the euro regarding the Greek story and the need to give a third bailout, that's not going to happen until next year. The September election in Germany is going to be a distraction. Doesn't really have any real flows, real effect on the euro. Anybody who tells you that it will have, that really doesn't. It doesn't really suggest that.
Okay, that's all we've got time for at the moment. To see more insights and opinions on the currency and commodities markets from top experts around the world, head to Dukascopy TV's homepage and search for Commodities Corner and Targets in Focus. I'll see you next time. Goodbye.